Welcome to the Broken Pie Chart Podcast, episode 366. All right. I'm your host, Derek Moore. With me once again is Shane Skinner. Both of us, of course, from Zega Investments. All right. Kind of one of those weeks, Shane, where it's like we had a good day, we had a bad day, a good day, a bad day. I didn't check what we're up or down for the week. But I guess what was a little bit surprising was the Nvidia earnings. And not that they were bad, they were actually pretty good. But what we're seeing in Nvidia is really sort of a price story. Shane, if it's all right, I'll kind of lay out the case here of what we're seeing, and then we can kind of discuss it. Nvidia, their forward EPS estimates, so the forward analysts, what the analysts think is going to happen with Nvidia, what they're predicting, hit an all-time high, is about $8.25-ish per share on a per share basis. And then you say, okay, well, what about gross margin? So gross margin doesn't include things like marketing and other selling expenses, but gross margin is a pretty good proxy. So then you say, okay, what about gross margins? Well, gross margin forward estimates are a little bit lower, but they're not that much lower. Like they're 74, 63. I think at the high, they were probably more like 75 and a half. So, but they've been going back up since kind of coming down, June of 2025, that was sort of the low on their forward estimates. Remember, these are estimates. So then shares outstanding, it doesn't look like they've done a buyback or reduced the share count since September of last year. But remember, share count going lower means all else equal, the EPS goes up because it's on less shares, that type of stuff. And then I look at the sales and the EPS together. And the forward estimate on EPS and the forward estimate on sales are both at sort of all-time highs for estimates going forward. And the reason why I went through all this stuff is sometimes there's a thing about earnings quality. And I'm saying this very, very high level. Earnings quality means, like we saw the announcements this week where XYZ used to be my favorite fake symbol to use. Now it's Block. They said they're basically laying off, like half the company or something like that, 11,000 employees. But one thing I look for is I say, are sales growing and EPS growing? And the reason why that's interesting is sales could be contracting, but earnings could grow if they are buying cheaper inputs. They give you the frozen fries instead of the fresh fries, or they're laying off people to save money and juice their earnings. So it doesn't seem like that's the case with Nvidia. And then we come down to price and we look at the forward multiple. To give you an example, Nvidia, since making its high in the fall of 2025, what's happened is it's come down, gone a little bit sideways, but the earnings estimates keep going higher. And what you're seeing is at one time, Nvidia had probably, you go back a couple of years, their forward PE was something like 60. It's 22.72. I took this, I think it was yesterday, Shane, we did this. And so what you're seeing is as the stock has been going up, it's been getting cheaper on a forward valuation basis, meaning earnings are growing or earnings estimates are growing, actual earnings are growing. The stock has been, since 2024 is higher than it's been in an upward trajectory. It's a little bit sideways, flat recently. So you think about it. When I took this, it was 186 and change. Shane, what did it close at today? What did Nvidia close on the number today? I think it was what?
Yeah, not counting post-market, right at the bell, 177.19. Down $7.70.
So I'm not saying this is going to be, I'm not saying the multiple is going to, either contract or increase. What I'm saying is if you went back to a 34 multiple based upon the forward earnings estimates, I mean, basically you're taking something like 34 times, I'll call it 8.25. That would be $280. So I'll repeat, like, I'm not saying this is going to happen or not going to happen. All I'm saying is if you went to the prior where this is just in 24 or even towards in September or October, mid-year in 25. So they're not paying as much for forward earnings. And this is one of the things that's kind of interesting because we're seeing this in a lot of stocks, and we can get into whether this is healthy or not. But I mean, Shane, like we don't know where Nvidia's price is going to be. We're using analyst estimates. Is AI in the sixth inning? Is it in the seventh inning or the third inning? I mean, you would think picks and shovels, semiconductors, all that stuff. There could be new entrants, although the switching costs are high. The cost, the barriers to entry are high. But given the choice, I would rather see the price to forward earnings come down rather than sales coming down and them cutting a bunch of expenses to try and keep EPS or, EPS estimates coming down. So you have a case where the earnings are growing. The stock is flat as the earnings keep growing. And the multiple is you have multiple contraction. And I think, Shane, I mean, that's a long way of saying, like, sometimes it's good to look underneath the surface of what's driving markets. There's an explanation of why a price goes from one price to the next over a year, over many years. And it could be a change in the margins, a change in the sales, change in the share count. Share count can increase if they're doing a lot of stock-based compensation. You could also see multiples increase or decrease. In the 90s, a lot of that move was multiple expansion. Share counts actually increased, which ideally you want share counts decreasing. When you look at the last decade, a lot of that was multiple contraction. So, and I think the earnings, we always say, we joke around, this is the most important earnings announcement of the season. It kind of was a nothing burger, Shane.
Yeah, no, I think that you summarized it well.
Thank you.
I think that, yeah, absolutely. I think it's Nvidia's a case of the sort of pay the cost to be the boss, James Brown, if you will. If you're into football, it's the Mike Tomlin, the standard is the standard. And what I mean by that is Nvidia's established itself. It's number one in the market in terms of market cap size and just sort of where everybody's looking towards this future in AI. And so at this point, I think we've seen good and like strong Nvidia earnings and the stock goes up. I think we've seen them and the stock goes down. And I think we've seen them and the stock goes sideways. So I don't think at this point, earnings, like obviously a miss matters way more than a beat, I think right now, but your chart of it here summarizes it perfectly. And you're right to say that if you're bullish Nvidia long-term and the AI trade long-term, and you're hoping that this isn't nearly finished, you're hoping that you see the contraction down there, the multiple, and less of a sell-off of sales and revenue. I shouldn't say sell-off, but a pullback in sales and revenues, things like that. Because like you said, if you get the sales pulling back, you're getting cut on one end of your business. And to alleviate that, keep things where they need to be with respect to margins, you've got to trim the bottom side of it. They are sitting on a ton of cash. And as you noted, they've not been shy to the idea of buybacks, or at least in this chart, it shows that. And so I don't think this is a situation where Nvidia is necessarily in a bad spot yet. But as we see, the stuff with the lending and the credit market, right, and the debt and AI, it's when Nvidia's biggest buyers become squeezed, if you will, and that ability to spend money on this CapEx either A, becomes harder to do because it's harder to finance or more costly, or B, eventually, they don't have to buy as much because they're getting what they need. But I don't think that's nearly as likely as the potential of A. But that's really what's the threat to sales, I think. And then, if sales continue, maybe we see Nvidia on paper become cheaper because of that, based on the way the stock moves versus, where its price to earnings multiples are. But
that's
I'm with
what you
you.
described too.
Most important earnings. It is. It's just how this goes.
A little bit of what you're describing too is that if you were doing discounted cash flow analysis, if you were a pure value fundamental analyst, you would discount the expected future cash flows to the current, and you would put a valuation on the company, and then you look at the valuation into the shares and say, what's the right price based upon what I'm seeing? And when you do a DCF, discounted cash flow, what you're trying to do is make assumptions and make some decisions about the company you're evaluating. And one of the decisions you're trying to make is, for how many years are they in this sort of growth phase? And sometimes you say, well, I'll do a 5 or a 10 year, they'll be in growth mode. And then they're going to grow basically by whatever by GDP. And they become 3M. And I haven't looked at 3M, so maybe 3M's growing a lot more.
So it just plateaus is the logic, basically. Eventually that growth rate's going to stall, and then they're going to become steady, just sort of consistent.
Well, it's one of the reasons why I think Apple over the years and Amazon over the years has outperformed long run expectations, because you could have bought Amazon at like 1 times future or 0.5 times future 10 years actual earnings. And they grew into their valuation. But companies like Apple, they maintained high net profit margins for many years. And the idea is, classical economics says you have a blue ocean, there's no competitors. You go in there, you have very, very high margins. People are like, oh, that's really interesting. What are they doing? I want some of that. You have new entrants that push the price down, margins get squeezed, and eventually, margins go, and you enter more of a steady state. So yeah, it's like Nvidia.
That's a great point. That's a great point about the competitors. Like what happens if at some point their tech isn't number one or the only one that's capable of providing. It's not just about making the best, the product. It's about doing it in a manner that, is cost effective for the purchaser as well. And if someone can provide, it's Coke or Pepsi almost in a way. There's a slight difference, right? But more or less the same thing at the core. And so if we ever got to a stage like that, do you think that you see a huge ton of Nvidia's market share eaten up, and this becomes sort of what a lot of number one stocks you've brought on in the show multiple times? We talked about it, in various meetings. Like, how many times does the king eventually fall off in the market and they don't ever really make it back? IBM, the 80s versus now. What'd you have? You had
GE, you had AT&T, you had, yeah.
Right. So, and that's not to say those stocks are still around, right? Some people see value in them or a reason to own them. Others don't. But at the end of the day, just because a company is going to be around, 10 to 20 years after it, still doing something that it's doing now doesn't, like you said, it can plateau for a multitude.
All right. So if I was on a call today, we don't really, I was doing a little bit of what we call OCIO work, which is outsourced CIO, where you sort of lend our help with outside portfolio management, things like that. So, and one of the stocks that came up today was CRM. And since you and I had just gone through that whole Nvidia exercise, I decided to pull up CRM. Now, CRM is down 47% from its December 2024 high.
SaaS just getting slaughtered in general.
Yeah,
down the list because it's a long list right now. But yeah, CRM is a perfect example. Salesforce is everywhere in corporate America, and then a lot of software and just back end ops stuff for a lot of businesses. The reason why I went through it, as I said, and I had a guess
that I wonder if the earnings quality is getting hit. Like why are people selling it down? Of course. I mean, the obvious reason is that Salesforce is going to get disrupted because somebody will create a new CRM. And once people are comfortable switching to it, large companies are comfortable switching to it. Yep. The idea is that, or their margins get compressed. But I did look at sales. I looked at their forward sales estimates, and I looked at their forward EPS estimates. And I did a 5-year chart. They are, I should have asked you, but you know what, you were looking at this too, so I won't try and stump you. But if I ask most people, hey, the stock's down 47%, do you think their forward EPS and forward sales estimates are at all-time highs? And the answer is yes, they are. I can go back 10 years and see, a little bit further if I'm wrong. But yeah, I mean, their forward sales, their forward EPS are at higher levels. And this is another example of where this is according to Bloomberg, their forward PE is 14.65. So you look back and you say, well, December of 2024, it was 33.38. Their earnings estimates per share have risen. Their sales per share have risen. Their expectations going forward, 12 months. That's the interesting part. Like, it's not like analysts are saying, oh, I don't think they're going to, I think they're forecasted to earn like 8% sales growth or earnings growth. Is that a lot? I don't know. I mean, you and I aren't looking at CRM every day. So
it sounds like it's not doing poorly. It sounds like there are higher expectations for it, right? And so to see it trading so low, my question after you tell me all that information is it possible that a forward pricing of the disruption that could take place with it, say, AI has been a huge reason why SaaS has sold off so hard, right? There's a lot of people freaking out, and there's a lot of people arguing that there's just a need for mass reevaluation of companies in this space, right? My question then becomes is sort of this like a hidden repricing of the AI risk that you're seeing, where it's like until that AI product comes, we're going to expect Salesforce to continue to hit these numbers and deliver on these things. But there is this sort of looming thing out there that is at any given day, we could wake up and there's a product out there that could cut Salesforce revenue significantly.
I mean, do they still have a moat? That's really the question. Is there any moat there? And I remember when Salesforce disrupted other things. Like, we never had Salesforce way back in the day. It was internal systems that were built on, the legacy systems and things like that. Here's an example. Let me go to Exxon. And Exxon is sort of the opposite picture here. So Exxon, they're forward. Here, Shane, I'll send this to you. People don't realize him and I sometimes we'll chat pictures back and forth as we're doing, because we do this live sometimes. We don't even plan some of this stuff. So think about what's going on with Exxon. And here, I'm trying to talk and send you something at the same time. Okay.
Well, Exxon was one of the biggest companies in the world, right? At one point, I think.
But that's not what I'm getting to. What I'm getting to is look at the chart I just sent you. So the forward PE on Exxon is 21.62. It's almost as much as Nvidia's forward PE. No, sorry, it's complete opposite. The forward PE, yes, the forward PE is that. The earnings estimates is a little over $7 a share. Look at what's happening with their forward estimates. Their forward estimates are going the opposite direction, meaning this growth in Exxon has been multiple expansion. You see the difference there, Shane? Like how that's laid out? The blue line? Yeah.
Essentially, they're saying that they expect earnings per share to actually decrease, right? Slightly. It doesn't mean negative, but slightly.
No. Yeah, I mean, in December 9th of 2025, the forward 12-month estimate was 7.37. The forward 12-month estimate today is 7.037. That is lower than it was. And the forward estimates were, right around the same amount. And when I say forward estimates, it's like, okay, what's the next 12 months? And when you have earnings reports,
Right.
then you have like another quarter comes off, and then it's the next 4 quarters from them. So this is sort of, but look at, this is all like the blue line going down, the red line going up. The red line is the PE ratio. But this is the thing, like the difference between Salesforce and Exxon is Exxon's forward earnings are not making new highs. Let me look at sales because I didn't put sales in there. So
could you also maybe add crude over this? I'm just curious.
Well, yeah, and this is a little different because then you bring into, this is a very particular commodity. Now, with Exxon, you have the Venezuela situation. Guyana was thought to be, I don't know, maybe Venezuela will take that. They have a big field there that I think they're counting on. Their sales expectations are not making a new all-time high. So CRM, forward estimates on earnings, forward estimates on sales, higher than they've been in the last year. Exxon forward EPS is lower than it's been. Sales lower than it's been, but price higher. And this is why the game is tough here. Like people trying to trade this stuff and pick stocks, this is a very tough game.
Yeah.
Because you could be right on the company, but wrong on more buyers than sellers, more sellers than buyers.
Right.
That's the thing.
Technology, the trends, it goes to show you don't ever know. You can't actually truly know. It's, night and day. And I'm sure it's funny if you had shown, these two charts side by side, maybe not shown the tickers, I'm sure people would be just mind blown at one being the other. I would assume Exxon was the CRM chart and vice versa. If you're simply looking at, the way these ratios and these estimates are spread out here. But
yeah, no, that's the thing. I mean, you don't know. And so someone buying Exxon today believes that the market has it right, that earnings they're going to do revisions higher, or that the commodity itself, and markets are smart. Markets are forward looking and things like that.
Well, that's it. The product. I mean, I think a lot of retail probably thinks oil and simply, hey, what's one of the cheaper, more affordable oil equity stocks that I can go buy if they don't know about things like USO, right? Or they just don't care.
Yeah.
I mean, do you think that has
just on the market chain, and then we'll kind of move on? Yeah. I don't know. I was already talking. I missed your question. I was just going to say on the S&P. Sorry, I was pivoting to something else. So EPS growth forward 12 months on the S&P forecasted 13.36% growth. The 1 year plus one, the year plus one. So the next year, 14.7% forward growth. The forward forward PE ratio now is under 22. I remember at one point it was 23. So it's the same story here. Like earnings estimates are actually going higher over the next 12 months, but the market is basically flat. So you have more of a flat market. I mean, after today, I think it's pretty much flat. I'd have to look. But yeah, I mean, it's a flat market because earnings estimates are going up, but the multiple's contracting on a relative basis, on a percentage basis or a point basis more than the earnings are going up. And maybe the market has this right. Analysts aren't always right. Maybe the market's just saying, I'm getting out ahead of this. And so, all right, let's talk about PPI. PPI came in, quote unquote, a little bit hot, according to the pundits on TV today. And I did look at a little bit of the detail. So the BLS puts out this report, and PPI is kind of like final demand. So it's the producer inputs on final demand of goods, and there's different stages. There's these intermediate stages, 4 different intermediate stages. Just a little nugget here. Over 20% of the January increase in prices for final demand services is attributable to a 14.4% jump in margins for professional and commercial equipment leasing. They also mentioned that prices for system software publishing fell 12.2%. So this is a little bit wonky, and I won't go into it on this podcast. It's not because I wouldn't love to do an hour about inputs on PPI. It's just, most of the audience isn't going to want that. The margins component of PPI is this thing where it measures the change and these are not net margins. I believe they're gross margins which is what you sell it for, what the cost of goods is, and that's kind of like your gross margin. And then you have selling expenses, you have advertising, you have operational expenses, taxes, all that other stuff. But it's for wholesalers and retailers. And, quote unquote, it tracks the value added services of trade, such as storage and distribution. So there's a little bit of wonkiness here. And anyway, I don't think this is the end of the world, but I do wonder if we see some of these continue to tick up. The thought is, and why the market reacted here is, if the input cost to produce the final good is going up, at some point that translates into the price of goods. Now, we've really had no goods inflation, but services definitely, there's been inflation in services. So market didn't like this. They really liked the CPI. Was it last week? So a week ago we had CPI. They did not like PPI. So I don't know. I mean, I want to see a little bit more. I want to see this. I'm looking forward to next month's. That's a cop-out, I know. But that's the way I feel about it.
I wonder, maybe you'll have a take here. I wonder if this makes CPI this upcoming month matter a little more, maybe. Just because there's going to be that expectation to see what the follow-through is. It's funny because March, there's really not a whole lot going on, right? Earnings season's going to get quiet. Not that there aren't companies earning, but we've pretty much made it through now that we're past Nvidia for the big names, typically. You've got the Fed decision, right? We've got interest rate decision at some point in March. That'll be interesting. So I think with that CPI, PPI, I'm wondering if this might be a month where some of the macro stuff seems to move the market a little bit more now that we're through the earnings cycle and into a new year.
Okay, would it surprise you that there was only a 36.8% probability of a 25 basis point cut at the July meeting on Wednesday? Today, after PPI, there is it's actually factoring in a cut. And sorry, I did that wrong. It was factoring in the number of cuts on Wednesday there wouldn't be a cut in the July meeting. After PPI today, it's factored in for July again. And these things change. I mean, these are just probabilities, but I expected it to be the other way around, but no. And maybe that's why the market recovered. There was some stuff in there, because it opened down. We kind of had a little bit of a sideways day, and
sideways firmed up. Opened. Yeah. And I mean, look, the market. This is your weekly performance on the S&P, not counting the last hour of futures after the bell. You had a high of 0.74% move. You had a low of down 1.24%, and you closed down 0.3%. Given the nature of this week, the earnings reports, Nvidia especially, and a few, the PPI coming out today, closing down 0.3% on a week like this that's not that surprising. I don't think that's very abnormal. I think you're happy to see it have pulled back up from being down 1.25% at its low to recovering and, like you said, sort of keeping itself upright today.
Sam Altman was on Squawk Box this morning on CNBC. He was on with the CEO of Amazon. I think they were talking. They must have done another funding round. I think I saw the latest valuation was something like $750 billion, so not quite $1 trillion. And Sam Altman, by the way, of course, is involved with OpenAI. They They asked him, like Andrew Ross Sorkin asked him, hey, when are you going public? And he's like, well, at the appropriate time. So he didn't answer it, but why would he? He doesn't need to. I can't wait to see their S1. And for anyone who doesn't know what an S1 is, when a company goes public, they'll issue a document called an S1. It's the first chance that the public, because private investors may see some accounting or pro formas or whatever, but that's the first chance the public gets to see like what their earnings are, what the risks are, like their balance sheet, all this type of stuff. It goes in an S1. Famously, what was I can't remember the guy's name now. Why is it blanking me? There's been movies about it. The co-working space. What was that called?
Office space?
Well, they had office space. WeWork, yeah. Like WeWork put out their S1 and people were like, what the?
Yeah, nobody wanted to touch it. Right.
Well, you can go back and you can look at Pets.com's S1. You could look at Google's or Amazon's S1. Like you can find them out there. I can't wait to see their S1 because if you're telling me they have a valuation of $750 billion, that puts it in the range of, we just looked at the top 10 because we have that one strategy that has the top 8 stocks in it and another one with a little bit more than that. Anyway, I'm kind of looking forward to that. Like S1s, when you get a look for people like us, it's exciting. I remember when Lyfts came out and Lyft did a good job. They had colors and graphics and everything. In the old days, it was just like black and white, nothing there. WeWorks had a lot of graphics, a lot of pictures, but that was really funny. Like right now, I think a lot of people are switching to Anthropic for Claude. Claude is from Anthropic.
Yep.
But these aren't public companies because look, if you're a private investor, you obviously are not. I haven't seen their numbers, so you would never listen to anything I say. I find it interesting. All right, that was just an aside, Shane. I didn't mean to derail us, but he was on today.
It's relevant. It's relevant. It's big stuff.
Well, it's relevant because Microsoft has, and some of these other big companies, they talked about another round of investment, and I believe Amazon has investments in Anthropic too. I could be wrong there, and those are sort of like convertible warrants, or it's almost like a convertible bond. I mean, it's equity. They own a stake, and I don't know how much.
Right. There's some risk associated with it if they don't follow through. But I think the logic too at this point is there's enough that's been created via some of these that even if it doesn't survive as Anthropic itself, value is going to be extracted in some form or another, and Amazon's not going to let it go to waste, I would think.
And I don't know if Anthropic's talked about going public, but OpenAI, I believe, has teased it. I think Elon Musk with SpaceX has teased it. And I'm just thinking between SpaceX and OpenAI, I mean, what's the valuation going to be on SpaceX? It's probably, is it over $1 trillion? I mean, we'll see when it comes out. And the reason I bring this up, Shane, is like between those two stocks for an IPO, could be $2 trillion or more of you don't know how many shares they're issuing or what they're holding back, but that's like a big chunk, and they wouldn't necessarily be in the indexes right away, but.
Well, so that makes me wonder though. I mean, that begs the question, have you in your career ever seen one or two companies like that are potentially going to come to market and while not being included in indexes initially, like you said, I think those valuations that we just, and who knows if they hit those valuations, but if they did right out the gate, I mean, you're talking about two private companies IPOing and immediately being in the top 10, top 15 market caps in the world. I'm trying to think if I've ever seen that happen. And I don't think I have in my lifetime.
All right. So Google went public in 2004. Remember the old thing, Domino's and Google went public basically the same time. And for many years, Domino's had outperformed Google, which is just an aside. According to a quick internet search, because I didn't know this off the top of my head, The initial valuation was approximately $23 billion. And shares offered 19.6 million shares, $85 a share. Split adjusted, that's $2.13, split adjusted. So like their valuation is $23 billion. I'd have to think what the top 10 stocks were back in 2004. If we had, let's make a note of this. Maybe we'll come back to it. Or maybe we won't. Maybe we'll just forget. We always forget stuff we say we're going to talk about. But I think Google was one, but Google wasn't. I mean, people knew about Google, but people didn't really know about Google. Like everyone wasn't just asking about it. To be honest with you, Snapple, the iced tea company, was the one in the 90s that I remember getting more people asking about. Many more people asking about that than Google, which is... So, no, we'd have to research that. But I think, OpenAI, Anthropic, SpaceX, these are the companies, there's other companies too that will be interesting. All right, let's talk about options. So you had asked me, and you and I know because we build portfolios and a lot of times we're using options as a hedging vehicle. But you had mentioned that the skew is, and I'll let you talk about what you're seeing in skew, was getting a little bit high. And the Cliff Note version is like, it means options are more expensive, i.e. hedging is more expensive. You and I agree that options on the longer end, like, a year out, let's say on SPY, hedging is not super expensive right now. I say it's normal. It's not overly cheap, but it's not it's just normal. It's not elevated. So I think what we're seeing on the short end, though, and what you're seeing in skew, has to be a reflection of just the dispersion in the companies. Like this is a stock picker's market right now. So explain what you mean by skew for the audience. All right. And then we'll kind of take a look at this.
Yeah. So skew, the initial sort of like report that came out this week was that SPX skew is steepened to a 1-year high. SPX being the S&P 500 index options. Skew in options essentially meaning like volatility skew is the phenomena where implied vol varies across different strikes and expiration dates. It's the same expiration date, and the same underlying. But basically the idea is that the implied volatility of an option that's trading at the money is different than the implied volatility of an option trading 30% at a 30 delta. So say 3% out of the money, 5% out of the money. But the idea is that it's not even across the board. Volatility isn't just a constant 10% on every single strike of that expiration date. And so what we've seen here this week is, and you're right, it's a huge part of this is rotation. We're seeing a ton of shuffling around. You're seeing names that are starting to run out of nowhere that haven't in a long time. We talked about the Exxon and the oil. That's actually a huge part of it is the commodity side. Commodity volatility in terms of cross asset vol saw the biggest increase week over week over the past week. Oil and gold leading it. And I think that, we're not going to dive down oil and gold right now. We've talked about it quite a bit, but that's not a surprise, right? You're seeing a ton of movement in those areas. And so the repricing of the risk curve and the expected movement that could be made is only natural because of that. With respect to SPX skew, what we're referring to here when we say it's been the highest it's been in 52 weeks is 1 month skew. And so what that basically means is that the cost of, say, going 1% out of the money to the downside and buying or selling a put is significantly different than going 1% up in the market and buying or selling a call that's 1 month out. Think I did a good job summarizing that there?
Yeah, I mean, I think that's right, and that's
It's sort of, it can really throw people, I think, when all of a sudden you look a month out and you see that puts are trading, $50 out of the money. The put is trading for $5 to $10 more than what the call is trading, $50 out of the money to the upside. I think sometimes people see that and they assume that it means bad things are coming. I wanted your take on this. And again, it's not spiked on the 1 year. We did that research before the podcast, right? It looks pretty normal right now, the cost to hedge something 1 year out versus what we typically see. But 1 month out, isn't that sort of how this starts? Is that vol creeps up, uncertainty starts to spike on the front end first, and then it might bleed into the back end later.
I mean, there's less of an effect of interest rates on the very short end because if you were borrowing money or if you were loaning money, the accumulated interest isn't that much on the front end. So that's one thing. And if interest rates were zero, all else equal, and there's no dividend, you would expect the calls and the puts at the same, equidistance to be right around the same. Like the at the money is to be the same price, put and call. So I think that's one thing with interest rates are not playing in there, but we are seeing just now we look at maybe a little bit of demand cycle here, the demand side. And, but that's natural. I mean, ever since 87, there's been a skew, and the skew means that very deep out of the money puts have a little bit more value and more implied volatility, hence the premium there, than very far out of the money calls. And it's just kind of one of those things where, naturally people maybe buying tail protection or other things, they're buying that very, very deep out of the money stuff. So, but we are not seeing the cost of hedging go up farther out. We are seeing, like on a 1 year basis, like we said, we could run the skew on that. And I was going to say, write it down. We'll come back and talk about it next week. We'll talk about different stuff next week. But
I'm interested as a side project period.
Yeah. But you do see these things, and so I mean, I think that's an interesting data point. In some of the commodities, they work a little bit differently. Like in currencies, the skew, at least a lot of years when I used to really follow currencies and really follow the options on options on currency futures, there was less of that skew. So I don't know, but I think it's just kind of like the VIX today finished where VIX was. I mean, it wasn't crazy. It was just, 20.
I've got 1986 on the VIX on the close. It had broken 20 multiple times and it couldn't hold. I mean, 20 seems to be this revolving level. We just keep trading.
All right, so that's more of an interesting thing where we're within X% of an all-time high. We're kind of sideways. Year to date, we're kind of flat. And yet the VIX is that high. Like, to me, I think the VIX seems too high.
Right.
Famous last words, right?
Of course, always. I mean, you've got what you've got going on. Tensions in the Middle East.
We always have that. Come on. There's always something.
Like something's going to happen. Well, right. Something's going to happen. And it's almost like, does this all go back to like, did a bunch of tail risk hedging get put on for fear of something really bad happening? All right. So the dog wags the tail. Maybe this is it, Shane. Like you've made this point before. Vol goes up, implied vol goes up, skew is changing. What does that mean? The market makers have to sell more stock to hedge where they have been the dealer and selling. People are buying protection from them. So they're selling those puts in theory. And to hedge that, they got to short more stock to hedge it. Like it's sort of a dog wags the tail wags the dog. What am I saying? You know what I'm talking about? Yeah, tail wags the dog, but it's exactly that. And I mean, that's like, this is going to be very generalized here, but like, say there was a sort of a tail risk put buying program going on across a couple of funds, or people across the street were just deciding to buy tail risk. Like throughout the process of those puts being purchased, you're right. The market makers are selling those and thus selling into it. And so then what happens? We eventually get to that thing that the protection was being purchased for, and it either turns out to not be that big of a deal, which what happens immediately after that? Puts start getting sold. Market makers start buying puts, which means they're going to have to, all that stock they shorted into the puts they were selling, they're going to have to buy it back up. And that's where you see those vol crushes, the squeeze is higher. Or obviously something, let's hope not, but something happens and they were right to buy that tail risk. And that's when things can get nasty, markets can get wide. But it's interesting that you mentioned, like, the pointing out the VIX consistently trading at 20 while we're basically flat on the year. It's a little elevated in terms of vol.
No, I think so. I think if we traded flat, like that, a VIX at around 20, or let's say high 19s, above 18, you would think we're in more of like a slower 5%, 10%, 7% pullback.
Yeah, something like you'd expect us maybe down 3% right now, but it's been stable and steady, nothing crazy. Would you say like 1920s, where essentially people typically perk up and go, okay, what's going on? But
yeah,
but at the same time, we've seen, I think at some point, and this is just going off the top of my head, but I'm pretty sure at times during the previous Trump administration, like I think VIX held over 20 at one point for a while, and the market went higher. Just because VIX is sitting at 1920 doesn't mean we necessarily have to go down.
All right, so here's the thing, and we're not talking about like a short squeeze, although you can have short squeezes. What we're talking about is like it's almost like an implied volatility squeeze. And to your point, if VIX was 13, that means if the VIX starts to go like there's not that much room to go lower. But let's say the VIX goes from almost 20, just under 20, back down to like 15. What that means is people in theory have to buy stock because they don't need the same amount of stock to hedge because the net deltas are dropping. Delta goes down. I should really write an article about this, but delta goes, the net delta you have to hedge goes down. So that's the reason why when the VIX goes to 40 or 50, if markets just stabilize and volatility drops, like you have this buying that comes in, and it's almost akin to the buying you see with a short squeeze where people are buying to close. The buyers are causing a problem and the short sellers have to buy to close. And it's similar to that. So yeah, like if you're a bull and you're saying, hey, I almost want a short type squeeze, like ideally you see volatility drop and there'll be a little relief there. I mean, we'll let you know when it happens, right? But that's kind of the deal. So, all right. I was going to talk about short box spreads, but I realized we're already sort of getting to the end of time. So
that'll be a fun one.
Yeah, maybe we'll talk about that. But it's something we do for people is it's synthetic financing because, and we call it synthetic because you use a four-legged options trade to generate a credit, which is basically borrowing money, and there's an implied interest rate and all that. So I've been getting a lot of questions about it. We've done it we do it for clients and for advisors' clients, but it seems to be catching a bit, as they say. Like I'm starting to see articles about it, and it's something that's been around for years. I'm talking years, like the 90s. I remember these, and with commissions higher in the 90s, it didn't make as much sense. So, all right. Shane, any recommendations this week?
Yeah, I started a new book, so naturally I got to tell everybody about it. It's called This Time is Different, 8 Centuries of Financial Folly by Carmen Reinhart and Kenneth Rogoff. I hope I said that right, Rogoff. It's interesting. It's essentially a quantitative analysis and a look at 8 centuries worth of financial crises to show patterns of it comes down to a lot of excessive borrowing, asset bubbles, sovereign debt defaults. So maybe not everybody's cup of tea, but it's interesting so far. I kind of like it. We'll have a follow up hopefully.
This was published October 1st, 2009. So good timing if you're talking about 8 centuries of financial folly. That was,
of course, naturally.
Wonder why they never did an update on this. You'd seem like they could do like the European debt crisis or any number of things. Well, I don't remember ever reading the book. If I did, I don't remember it. But okay, that's good to know. Where Money Goes to Die, I feel like should be on your list.
Where Money Goes to Die.
When money when money dies, it's about inflation. When money dies.
Nightmare of deficit spending and devaluation and hyper. Oh, this looks great. I love this.
Yeah,
they're sweeping up cash in the street on the cover. That's awesome.
Yeah, hyperinflation in Weimar, Germany, and it's about basically people would be more apt to like wallpaper the walls with currency because it was that worthless.
Wow.
And it's Adam Ferguson. Yes, Adam Ferguson, When Money Dies, came out in 2010. This is right up your alley, Shane.
Oh, I love this stuff. No, this is a great recommendation here. I'm gonna have to order this one.
That's a good book. Okay. The other thing. Okay, so I have a recommendation now. You know, I continue to watch The Pit, which is on HBO Max. It's good. Like, it's really good. I'm almost mad though, Shane, because, and I always complain about this, HBO Max, Apple TV Plus, they don't give you all the episodes. Like, just give me all the episodes and then let me figure it out.
It's the worst. It's, yeah.
I've been doing this week to week until April. I'm like, come on.
Yeah, you got 2 more months. Strap in.
Yeah, it's a really good show though. If you haven't seen it yet, it's season 2, and then Drive to Survive. This is a pre-recommendation. So last year I wasn't as happy with the series, and part of it, Shane, I think, is because I've been watching Formula One. That now I already know what happened. Where early when I was watching the show, I mean, this is season 8. It was like, oh, this is really interesting. I'm getting to know these characters. And then I started watching it, which I think a lot of Formula One fans came into the sport through this. So it's been a big success for them. But yeah, it's coming out, and Netflix, thank you, will drop all the episodes. So if you want to watch, I don't know, probably 8 hours or whatever it is of Drive to Survive, you can do that.
Is this kind of like Hard Knocks? I've not watched this.
That's right.
Is this kind of like a Hard Knocks? You get to see behind the scenes of that's interesting. I could see why this cultivates some new fans.
Yeah.
I'm sure this holds other people down, getting to see the behind the scenes. But
well, the first race is coming up, the Australian Grand Prix. I believe it's March 7th is the first race. So usually they drop this a little bit before the season. Yeah.
Yeah, Saturday, March 7th.
Oh, Saturday. Oh, nice. Well, it's real.
Well, that might be Saturday in Australia, which, I
will tell you, I've been on calls with people in Australia, and it's like, you know how with me, I'm being on the West Coast, especially, once we don't time change. And so we're 3 hours behind New York in the summer for most of the year. And then we have the smaller winter window. We're 2 hours. And it's hard enough, like getting that straight in your head and people, scheduling meetings. When you schedule a meeting with somebody in Australia, it's like, okay, let me schedule it for this time, which is your time tomorrow, like 8 a.m.
It's great.
Like, we're going to have a meeting on Wednesday, which is Thursday at 8 a.m. for them.
Like a slide ruler, calculator, an index.
You kind of do.
Map it out.
You kind of do. All right. I think we solved all the questions in finance and all the problems in the world. Shane, have a good weekend. For everyone else, we'll talk to you soon. Take care.